Hello, I'm Maria Dawes. I'm one of the portfolio managers on the private wealth team at Capstone Asset Management. Welcome to another edition of Your Wealth Matters. I'm joined by my colleague and fellow portfolio manager, Janet Kinsing, today, and we are going to look at interest rates, the past, the present, the future, and most importantly, what are the implications of interest rate changes within one's portfolio? So Janet, it's no secret that interest rates have been at all-time lows for many years now. So walk us through that backdrop, please.
Hi, Maria, and yes, my pleasure. We have enjoyed from a borrowing standpoint, I guess, a prolonged period of low interest rates for a number of years now. Financial crises starting from 2008 have driven interest rates to just above zero and even negative in some parts of the world, with the goal of spurring on spending and economic growth. Now, the controlling of interest rates, at least short-term interest rates, is based on a central bank's decision. So in Canada, we have the Bank of Canada, and to the south, we have the Federal Reserve. Their changing of borrowing rates, which trickles through to our financial institutions, is dependent on namely two things, employment numbers and inflation. It's a bit of a fragile time right now because although we have inflation, which is ever creeping higher, we also have employment numbers, which have been, not surprisingly, pretty volatile considering the circumstances of COVID, which we are still very much affected by to this day, unfortunately. And the job of the central banks is to find this precarious balance. Both the Bank of Canada and the Federal Reserve meet 8 times a year, and therefore there are at least 8 opportunities a year for rates to either increase, decrease, or stay the same. And what has also become of more importance in the past few years, I'd say, is the forward guidance, which tends to be presented following these decisions. The forward guidance gives us hints on how hawkish or dovish the powers that be are feeling. Hawkish meaning slightly more aggressive and dovish meaning slightly more passive. You know, hawks are aggressors, whereas doves are the symbol for peace. And while it is slightly surprising that there weren't any rate hikes at the latest meeting this past January, it is almost a done deal that this will happen in March. So it's interesting because the markets don't just sit back and wait. They make their own predictions based on clues, such as the dot plot, which we won't get into today, but forward guidance as well. And the implication here is that a lot of what we expect to happen is already baked into the bond prices. So how have bond prices been affected? Maria, maybe I'll pass that over to you, and perhaps we can also use this opportunity to remind our viewers why interest rates are inversely correlated to bond prices.
Right. So yes, to answer your first question, if expectations are that interest rates will increase later in 2022, say in March, then bonds will come off in price or they'll drop. We saw this already happen, in fact, with the bond index in 2021, which was down just over 3% for the year as investors anticipated a rate hike. And to your other question, which is why do bond prices and interest rates move inversely? Well, think of it this way. We want to earn more interest in our bonds, right? So if we know that higher interest rates are in our future, and that will make the existing bonds in our portfolio less valuable, and we will try to trade them in for something at a higher rate. And the opposite would be true as well. If we expect interest rates to decrease, we would want to hold existing bonds with the higher rate, and those would become more valuable, and their price would therefore go up. So Janet, it also may be useful to explain, how does the central bank's raising of rates filter through to our system?
Yes, excellent point. So the central banks control the short-term interest rates. Longer dated treasuries are still dictated by the market. And I won't go into that too much, except to say that short-term interest rates indirectly influence long-term interest rates. But when central banks, let's say in this case, raise rates, they are effectively increasing the overnight borrowing rate with financial institutions. Financial institutions will then pass that cost on to borrowers, and that will translate into higher mortgage rates as well as other loans. On the flip side, and unfortunately, the last thing to increase would be our savings rates. So those are some of the effects of the central bank's actions. As rates push higher, investors are more inclined to invest rather than spend, and that can serve as a way to curb inflation. It's a very simplistic overview, but hopefully paints a picture. One thing that we are purposely not touching on today, but which I'll at least mention, is the central bank's ability to inject liquidity into the system through quantitative easing. This is separate from the adjustment of the overnight rate done by central banks. And while that is another form of monetary policy, we're choosing to exclude that for simplicity. Now let's get to the meat of the conversation, which is what can happen to clients' investment portfolios as interest rates rise.
Right. So as we alluded to previously, because bond prices move opposite to interest rates, as interest rates go up, we can expect bonds to drop. And the magnitude of this drop is determined by the bond's duration, which is its sensitivity to interest rate changes. So if the duration of a bond is high or long, then its price drop is likely to be large when interest rates go up. This might be confusing, but bond duration should not be confused with time to maturity. And I'm not going to go into its complexity today, but just know that all bonds are not created equal, and some will be more sensitive than others and could drop more dramatically. At Capstone, our fixed income pool is the investment that holds traditional bonds, and we have focused over the past few years on keeping the duration short in order to mitigate as best as possible against the risk of rising interest rates. We've also adjusted our holdings to an overweight position in non-traditional fixed income investments, which tend to be less sensitive to changes in rates in the short term. Both of these important strategies have helped our fixed income pool achieve a return of 5.59% in 2021 compared to the traditional Canadian bond market, which was negative 2.8% last year. So far, I've only talked about fixed income effects, and it's also important to note that volatility from interest rate changes can trickle through to the equity markets as well. As debt becomes more expensive, companies potentially become less profitable. Furthermore, maybe you can now find suitable interest rate in the bond market, and so you might move out of the stock market and reposition your portfolio. Anyway, interest rates are significant influencers in our investment outlook on both the fixed income and equity side of the equation. And whenever we see risk on the horizon, our advice stays the same. Make sure you're diversified and have investments that are not correlated together.
And I think that's a perfect final conclusion, Maria. So rates are on their way up, and it's all the more important to ensure your portfolio is properly positioned. And if you haven't touched base with your portfolio manager lately, please do so. Thank you for joining us on another edition of Your Wealth Matters.
Bye.